growth more resilient. India's forex derivative market is in a tight spot. Liquidity is set to dry up across foreign currency derivatives, which are traded on stock exchanges, and that is because of an RBI directive, which is set to come into effect from the 5th of April, which only allows for trades to hedge forex exposure. Now, the change has sparked panic across trading desks, as many expect volumes to plummet between 80 to 90%. Prashant is standing by to explain what all of this means, the impact of the RBI circular. Prashant.
Well, this is an important story now, which has implications for the currency derivatives trading involving the rupee as it happens on Indian exchanges right now. Remember, currency derivative trading happens on the NSE, it happens on the BSE, it also happens on the Metropolitan Stock Exchange. So what's the issue that we have at hand right now? The RBI, in a circular in early January this year, that is 2024, said that exchanges have to inform users that they have to, that's the clients, the users, have to establish the existence of, and I quote, a valid underlying contracted exposure, which has been not hedged using any other derivatives contract, if required. Now, in simple words, the RBI is basically disallowed currency derivative trading with rupee involved on exchanges without an underlying position. So if you're not hedging a position, currency derivative trading involving the rupee would basically be violative of FEMA rules. FEMA, of course, is the Foreign Exchange Management Act. This, of course, all of this goes into effect from the 5th of April, that is this Friday. So it's imminent, it's happening now. Though the RBI notification is dated, I mean, it's a few months old, its actual full import only began sinking amongst brokers, amongst market participants recently. Brokers associations like ANMI, CPAI reached out to regulators seeking a clarification. The RBI, in an email last week to market participants, clarified on the issue, basically saying that there is no change. They actually said that we had clarified on the issue back in 2014, and this is, in a way, a reiteration of that. Exchanges, by the way, earlier this Monday, earlier this week, also kind of attached that circular from the RBI and sent it to market participants as well. So it would seem like the issue is settled, right? Market participants do believe that this will essentially, for all practical purposes, kill the exchange-traded currency derivative market. Daily average notional turnover for this segment runs into, a few billions of dollars a day. Many are predicting between 70 to 90% fall in these volumes as this rule kicks in. We at CNBC-TV18 have reached out to the RBI for clarification, but we are yet to hear from the Reserve Bank of India.
In exchange-traded markets, at least, you cannot have only underlying exposures being traded because there are no banks as market makers or designated market makers. It's a free market. It's supposed to be a free market. And markets are supposed to set the price. And you will need traders and speculators in a market if you want to create a free market. So it's very, very unfortunate. I beg to differ that the OTC market should be on par with exchange-traded markets.
The reality is, there is an onshore derivatives market, exchange-traded, and there is an OTC market. You really can't have different rules. And if needs to be changed, then that would require more of a policy decision than the regulatory decision. So that's where my thought process is. But I'm surprised, even after the 5th Jan circular, it just restarted it again in last week or so.
Well, 5th of April is when those new norms come into effect. Shares of JSW Energy hitting an all-time